Hello, everyone. Good day to you, wherever you are. I welcome you once again to yet another taxation class. And today we're looking at principles of withholding tax. Principles of withholding tax. So just give me some moment. Let me just share my screen so that we can start the class effectively. Just a moment, please. All right, here we go. I believe you can all see my screen. My name is Dr. Bafemi Oyewumi. I welcome you once again. So we're looking at principles of withholding tax, even at this particular point in time. What are the learning objectives? Number one, to learn about the concept of withholding tax. Number two, to talk about the history of withholding tax for you to appreciate, again, the principles of withholding tax as well, to know the objectives of withholding tax and to understand income subject to withholding tax, and then to know the rates of withholding tax and to learn about the advantages of withholding tax. So let's just continue. Let's look at the concept of withholding tax. When we talk about withholding tax, what are we really looking at? What are we referring to? Okay, the concept that you need to understand here. We say withholding tax is an advance payment of tax on the income of a taxable person, which is deducted as such by a person authorized by the relevant laws from the payments made to a taxable person for the supply of goods and services and remitted accordingly to relevant tax authorities. So we're talking about an advance payment. So withholding tax is not a new tax. It's not a unique tax. It's not a separate tax. It's just an advance payment of tax on the income of a taxable person. But this particular tax is deducted as source, okay, by the person that's been authorized by the government to do just that. And then accordingly, they will now remit, to the government on behalf of the person or the tax payer that deducted the money from his account. So when a contract is executed, when a contract of sales, when a supply is made, at the end of the day, before the payment is made to the person who made the supplies or the who carried out the contract, then definitely they will have to deduct the money and then keep the pay the person less amount while they pay their amount so far deducted to the government. So that's the concept of withholding tax. So it's not a new tax, basically. It's still part of the tax that somebody's, the taxpayer is meant to pay at the end of the year. But then this money is being deducted, the moment a particular contract is executed, the moment a particular supply is executed, or maybe when a particular dividends be collected or the order. So let's just continue to look at withholding tax. So to take, so look at the historical development of withholding tax. In Nigeria, the withholding tax, started in the year 1977. Okay, and the aim was for taxes to be collected, taxes which probably have been lost, to avoidance or to evasion, now be collected, and so that many people brought to the tax net. That is the whole intention, okay, of withholding tax. And then the authority for deduction is as source is contained in section 69, 70, 72, and 73 of Personal Income Tax Act of 2004, as amended in respect of individuals, and then sections 78, 79, 80, and 81 of CETA, that's Companies Income Tax Act of 2004 in respect of corporate organizations. It was initially, limited to rent, dividends, and directors' fees, but now it has been expanded to include, contracts, building contracts, construction contracts, and related services, all types of contract and agency arrangements, other than outright sale of purchase of goods and property, consultancy fees, technical fees, professional fees, management services, commissions, interest, and royalties. These are the expanded, areas where withholding tax are, being deducted from. All right, so let's go as we look at the principles of withholding tax. That's the focus of today's lecture. Number one, withholding tax is not a separate tax. Please take note of that. It is not a separate tax. It's not a unique tax on its own. Number two, you have to take note of this. Withholding tax is an advance payment of income tax of a taxpayer. I've explained that before. An advance payment of income tax of a taxpayer. Number three, withholding tax does not confer an exemption from the filing of annual returns by the company which has suffered withholding tax. What does that mean? It means that the fact that withholding tax have been deducted does not mean that the taxpayer will not still file his annual, returns to the relevant tax authorities. You still have to file it, and then at the end of the year, you now deduct the withholding tax that you suffered from the total liability of tax that you are meant to pay at the end of the year. So the number four, the tax is normally deducted at the source where the payment is being made to the beneficiary. Okay, it's deducted at source. All right, withholding tax is available to offset against the income tax liability of the taxpayer or the company in a relevant period. So it's always available to be used against or to offset against the income tax liability at the end of the relevant period. A taxpayer has no option. That's the last one. A taxpayer has no option as to whether to pay or not. Every taxpayer just have to pay because it is mandatory. It is statutorily required that the person that is making the payment, okay, should deduct withholding tax. So you have no option. You can't say that, okay, I don't this, I won't suffer withholding tax. So you have to pay withholding tax at the end of the day. Okay, withholding tax deducted by the person, by persons, companies, or accredited agents of government is to be remitted to FRS or SIRS within 21 days or 30 days of the following month that the transaction took place respectively. So this means that for FRS, Federal Revenue Service, and State Internal Revenue Services, you have to remit the money to the government within 21 days after the month or the following month that the transaction took place, or 30 days as a case of the State Internal Revenue Service. Okay, when the taxpayer fails to deduct or having deducted fails to remit withholding tax to the relevant authority, the amount due attracts a penalty. We're going to talk more about that later. The amount due will also be subjected to interest at the bank lending rate from the date of the tax becomes payable until it is paid. So that is another point there. Apart from paying penalty, you must also be ready to pay interest as well. Withholding tax is an advance payment of companies' income tax, not VAT, not capital gains tax, not petroleum profit tax, but companies' income tax. All right. So hence, it can only be used to offset income tax liability. So it's only the income tax liability, complex income tax now, that you can use to offset. You can use to offset PG or maybe pay as you earn. You cannot use to offset, value-added tax. You cannot use to, offset capital gains tax. It is only complex income tax that you can use it to, offset. So we're still talking about, the principles of withholding tax. And then withholding tax is deducted and remitted in the currency of the transaction. So if the transaction is carried out in naira, you pay in naira. If the transaction is carried out in foreign currency like USD, that's talking about dollars, of carried out in pounds sterling, or carried out in euro, it is the currency that the transaction has been used, or the transaction used, that's what you're going to go to pay. All right, you don't convert. You pay to the federal, to CBN, that's Central Bank of Nigeria, and then they will not be the one to remit to the to pay back to the relevant authorities. Transactions that are ordinarily are not liable to tax in Nigeria are also not liable to withholding tax. Okay, so let's go ahead to talk about the objectives. What are the objectives? Number one objective: the introduction of withholding tax regime is to address the problem of tax evasion. So you cannot escape it. Once you carry out business, or you do a transaction, or you carry out, a contract or supply, you have to pay withholding tax. So you do not. It prevents tax evasion. Number two, it encourages full disclosure, transparency, predictability, and fairness. Number three, it is to ensure that taxpayers are correctly taxed as well. Number four, to serve as a very simple source of revenue to the government and to broaden the tax net of the government. So that is the major, those are the reasons why the objectives of withholding tax, withholding tax. Let's go and look at the incomes that are subjected. Okay, incomes to be subjected to withholding tax. Number one, rental income. Rental income. So when we talk about rental income, this includes rental income, both real and personal property. Both real and personal property. As a general rule, income on property, rent, hire, lease payment, or royalties situated in Nigeria is liable to tax in Nigeria. So the place of payment notwithstanding. So where a person rents or hires properties, services from another with a tax rate of 10% will apply. But where a person provides service to another, okay, using his equipment or facilities, the transaction become a contract or service rather than rental or hire. So we're saying here that when you carry out a transaction that has to do with you renting out a particular property, personal property, okay, to a tenant, then withholding tax is meant to be deducted from the payment, to either the landlord or the agent, as the case may be. What are the other, incomes? Now, we talk about interest income. This is income from investment of every kind. Your interest income will have to also be subjected to withholding tax. So withholding tax applies to income from government securities and income from bonds or treasury bills. Interest on loans paid by Nigerian companies also is often not subjected to withholding tax. So please take note of that as much as possible. Let's talk about dividends. The next one is dividend. What is dividend? Dividends is income derived from the ownership of shares of a corporate entity. So when you part own a particular a company and they pay dividends to you, that dividend would definitely suffer withholding tax. All right. But of course, when the company is non-resident, the dividends that is paid or the tax imposed on it will be regarded as final tax, where the corporate bodies are allowed to recoup the withholding tax deduction where the dividend is to be redistributed, as frank investment income. All right. So we talked about, all of this, earlier in my earlier video. So you can just go back to my YouTube channel and watch, as much as possible and learn from it. So royalty is another, income source that you have to, deduct withholding tax from. This refers to unearned income, which accrues to the owner from self-developed asset. And of course, this asset could be, patents, trademark, copyright, materials, and that is why you have to pay when they pay royalty to the person, then the person will have to suffer withholding tax. Consultancy, professional, management, and technical fees will also, be subjected to withholding tax. All aspects of building, construction, and related activities, all types of contracts, activities, and arrangement other than outright fees of purchase will also suffer withholding tax. So let's look at the rates. These are the rates, the tables that we have here. The applicable rates of withholding tax. You can look at the types of payment. These are the contract types or income that will definitely suffer withholding tax. We have dividends, interest, rent, directors' fees, royalties, commission, like we mentioned, and management fees, construction. All of these are the different, applicable rates for companies and therefore individuals, as well. So it's important that we take note of this rate so that when you have questions relating to this, the rates to apply, as much as possible. Okay, but all these rates came into being at different times, and they change, they change over the years. Okay, based on it. So depending on the question, depending on the year that it's related to, that's the rate that you have to apply. So you need to go back and learn more about the rates that that was applicable to one particular year or the other. Okay, so that's just what we have to take note or take home from that. Now, when a tax, withholding tax is paid, it is expected that withholding tax receipt will be issued by FRS in favor of the taxpayer. So it means that you can't just say, my tax have been deducted and I don't have a withholding tax receipt. There must be a receipt. Okay, in the past, you have call it a credit note. There must be a credit note. That's what you're going to use, to offset your tax liability at the end of the year. So FRS is supposed to give you a withholding tax receipt, okay, until you have the receipt given by FRS. And of course, ditto, that's talking about the state internal revenue service. You cannot apply it. You cannot use to offset, your liability at the end of it. So you must always the taxpayer must always get, withholding tax receipt from the appropriate authorities. So let's look at the penalty. If somebody fails to deduct, okay, or after deducting, the person fails to remit, what are the penalties? We said earlier on that if anybody fails to deduct, there will be a penalty. Okay, Section 82 of CITA, that's Companies Income Tax of 2004, okay, specify that where a person who is obliged to deduct any tax under Section 78, deduction of tax from interest, Section 79, deduction of tax on rent, Section 80, deduction of tax from dividend, Section 81, deduction of tax as source of this act, that's the act CITAS 2004, fails to deduct or having deducted, fails to remit, to FRS within 21 days, okay, from the date of the amount, from which the date was deducted, or the time that duty to deduct arose shall be guilty of an offense, shall be liable to penalty of 10%. So now the general rule is that is this: 21 days in the following month after the month that the transaction took place. That's the general rule, now. Okay, so please take note. That's why if any malpractice fails to deduct or having deducted fails to remit, then you'll be made to pay interest or a penalty of 10% on the value of the amount that you failed to deduct. Okay, so now let's look at the development that took place last year. 2024. Okay, development that took place in 2024. It changed the whole landscape, as it were, when it comes to withholding tax, administration. In July 2024, the coordinating minister of the economy, Dr. Lawale Edun, issued a withholding tax regulations to enlarge the scope of the withholding tax mechanism in Nigeria. So the scope was enlarged, the mechanism was, broadened, at the end of the day. So eligible transactions and applicable rates have been reviewed in the new regulations accordingly. So the new withholding tax regulations are also known as deduction of tax at source, withholding in bracket now, okay, in parentheses, in bracket, regulations 2024. That is the name, okay, of the circular that came in respect of the new regulations applicable to withholding tax deduction. Okay, now these are the rates. It has been expanded. Dividend 10%. So we have, unlike before that we used to have just individuals and companies. Now we have corporate recipients, we have resident and non-resident, and then non-corporate recipient, resident and non-resident as well, meaning that we have corporate organizations that are not resident, in the country. We also have individuals that are not resident in the country. So what are the rates of withholding tax as it's applicable to the different transactions when they happen, when they take place? You can see dividend here, and you can see royalty, 5% for non-corporate, recipient. Okay, the non-corporate means the individuals and maybe on the corporate organizations. Okay, so we have rents, hire, or lease. So we have commissions, we have supply of goods, other than the manufacturer, the one that manufacturer produced. These are the different forms. Take your time to take your time to look at them, and then be able to go through and appreciate the changes that happen, in the course of, as prescribed by the new regulations as much as possible. So we talk about all the different rates given to us, and of course, they become applicable from July, July 1st to 2024. So let's move ahead to look at the regulations in details. Okay, the regulations require all entities, including businesses, tax-exempt organizations, government ministries, departments, agencies, and their payment agent to deduct withholding tax on applicable transactions. This includes a body, corporate or unincorporated, other than an individual. All right. So as an individual, you may not be able to say, I want to deduct withholding tax from any payment or whenever I go and transact business with these organizations. Okay, a government, ministry, department, or agency, a statutory body, a public authority, any other organization, institutions, organization, establishment, or enterprise, including those exempt from tax, and a payment agent on behalf of any person in A to E above. These are the people that have been given the authority, to deduct. Now, what are the specific things, now transactions to be captured, okay, that, that do not, attract, or rather, do not attract withholding tax? Okay, so we need to take note of these. Very, very important for us to take note of this particular, so transactions exempted from withholding tax. Okay, we said according to withholding tax regulations 2024, which became effective on July 1, 2024, the following incomes do not attract withholding tax. So all the different incomes elements or types that are excluded have been detailed, here. Imported goods, where transaction does not create a taxable presence for the foreign supplier. Goods manufactured or produced by the person making the supply. Distribution of dividend payment to a real estate investment trust or real estate investment company. Okay, it's also exempted. Insurance premium received by insurance and stockbrokers. Okay, but of course, please take note of the fact that commissions, is not exempted. Commissions are not invested. Pardon. Commissions earned are not, are not, are liable to withholding tax, so they are not exempted. Turnover income from dealership or distributive trade activity, only the commissions that are paid to the dealers will be subjected to, withholding tax. Okay, telephone bills are not subjected to withholding tax. Across the counter transaction, across the counter transaction. Okay, so these are transactions carried out without an established or prior contractual relationship in which payment is made on the spot. So when you go over the counter, you want to buy anything, they're not meant to pay, withholding tax or suffer withholding tax. Reimbursable costs or out-of-pocket expenses should not also suffer withholding tax. Interest and fees paid to a Nigerian bank by way of direct debit or to the account will not also suffer withholding tax. So when you go to the bank and they charge you interest, definitely you cannot say you want to take withholding tax from me. Supply of liquefied petroleum gas, LPG, compressed natural gas, premium metal spirit, PMS, automatic gas diesel, that's gas oil, that's diesel, dual purpose kerosene, that's kerosene, TPK, are not meant to also suffer withholding tax. Winning from games of chance and betting or reality shows with content designed to promote entrepreneurship, academics, technological, and scientific innovations. Please take note of qualification there. So that means that it's only those that have been, meant, those that are, be carried out for the purpose of promotion, entrepreneurship, academics, or technological or scientific innovation. Those are the ones that will be exempted, from withholding tax. Okay, let's look at the calculation. How do you calculate withholding tax? The calculation of withholding tax is very, very easy. So what you have to do, you have to know the appropriate, and applicable withholding tax rate for that income. Okay, we saw the categories of income, transactions that withholding tax are meant to deduct, be deducted. All right, ascertain the amount to be subjected to withholding tax. All right, so when you give an invoice, the value of the invoice should be stated, and of course, there will be a charge or element of 7.5. Okay, but it is the value of the transaction that you're going to apply withholding tax to, not the total invoice value at the end of the day, not the total, figure at the end of the day. Multiply the income by the applicable tax rate. Remit the sum of this to the respective tax authority on or before 21st day. That's for FRS at 30th day for State Internal Revenue Service. For example, if a tax collector, look at this example, I was paid 1 million. If a tax collector charged, I was paid 1 million for his services to XYZ, lead company in December 2024. How much would be deducted from the amount as withholding tax? So you have to multiply the value of this transaction, that's 1 million by 5%, and that will give 50,000. So company XYZ will be required to remit 50,000 to SIRS. So please pardon me here. SIRS within 30 days in January 2025. It's within 30 days, and not 21 days. I'll adjust this. So that's 30 days and not 21 days. Okay. All right. So let's look at withholding tax as a final tax. So withholding tax as a final tax means that once withholding tax is deducted, such income will no longer be subjected to tax again. That's what it means. Will no longer be subjected to tax again. So what it means that once withholding tax is deducted, as a final tax for applicable transactions or related to different, the type of company that you're dealing with, it will no longer be subjected to tax. It becomes a final tax at the end of the day. And of course, the transactions that will be related to this particular aspect are transactions that have to do with interest due to non-resident company, royalty due to non-resident company, rent due to non-resident company, dividends due to Nigerian companies and individuals, interest due to Nigerian individuals. So let's look at the advantages. What are the advantages of withholding tax? What are the advantages? Number one, it improves government's cash flow, meaning that government does not have to wait to the end of the year before they get revenue. Okay, so they have to, money comes to the government coffers more monthly basis. Widening of tax net, that's the second one. Okay, it assists the government in trapping income or transactions which of taxpayers who ordinarily would have escaped tax payment. Number three, convenience of payment is very, very convenient. The government do not have to, do so much, before this money begins to roll in, okay, there's a penalty for lack of deduction or failure to deduct and a failure to remit as well. So everybody wants to comply. So convenience of, and government is not paying any government, I mean, any agency or anybody for carrying that responsibility for them. So it's very convenient. Convenient of payment is also another point there. It reduces the incidence of tax evasion. So tax evasion is minimized as much as possible. It is ease of collection. Okay, ease of collection. That's another point here. So government, it comes in, at ease to the government coffers. All right. Governments, okay, they collect this money free of charge. I want to go back to what I said earlier on, in the point that I said, convenience of payment. So when it comes to convenience of payment, we are talking about the people that are paying now, suffering withholding tax. It's convenient because they don't have to wait until the end of the year when they pay a lump sum that their cash will not be able to, contain. So they pay in bits. On monthly basis, you pay. On monthly basis, you pay. And that means that you don't have to wait till the end of the year. And the whole money becomes a very huge amount before you begin to pay. So it becomes convenient, for you. So ease of collection means that government agencies, departments, and all of that are paying, okay, they are not being paid for the purpose of carrying out this assignment, but yet they still have to do it. Determination of taxpayers' income. Now, it helps to determine the taxpayers' turnover at the end of the day, because anywhere that now we talk about tax programs that the FRS is using. So, for example, if a company has deducted return tax on your behalf and remitted, you can't come back and deny to say, I did not make sales, I did not make turnover. No. So it helps to determine the taxpayer's income or revenue at the end of the year. So that means that these are the advantages, okay, withholding tax. So withholding tax administration or mechanism is very, very advantageous. Of course, there are some bottlenecks, but of course, this is where we're going to just we're only looking at taxation of we're only looking at the withholding tax, today, and the advantages that come with withholding tax administration. And so that will bring us to the end of today's class. Thank you for watching and thank you for joining. If you have been well educated, if you have learned one or two things, from this particular video at this particular point in time, please, I want you to subscribe to my YouTube channel, okay? And then, of course, like, comment, and share it as much as possible so that others can also benefit, from it. And of course, when you subscribe, whatever it is that's also dropped, in the future that has to do with us, you will be able to see it and then also benefit from it. So please subscribe to my YouTube channel, and I trust that you'll be able to learn more, much more, along the line in the future. Thank you very much for joining the class and for watching this video. Until I come, your way next time, stay blessed. Bye for now.